Well, two of the largest U.S. supermarkets are merging. We talked about this before. Kroger has agreed to buy Albertsons for $24.6 billion. Now, this comes as a majority of executives find themselves altering their investment plans. As we take a look, 93% of CEOs say they've made alterations to investment plans amid geopolitical turmoil, and that's according to a new survey from EY. But over half still say they expect to pursue an acquisition in the next year. Mitch, EY America's Strategy and Transactions Vice Chair, joins us now. And you talked about this being that everywhere, all at once, similar to the movie, a lot of things that some of these CEOs are having to contend with. How is this affecting the landscape? What were the biggest findings in your study?
Well, I think not surprising, inflation is top of mind for all the CEOs that we spoke to. We interviewed over 760 CEOs around the world, and 65% of them expect their earnings to be impacted by inflation. And that's really due to the input prices, which include labor, raw materials, energy, and freight. There's only so much of that cost they can pass back on to the end consumer. So the CEOs that I work with on a daily basis actually are looking at ways to take out costs so they can still meet their bottom line, and other ways so they can reimagine their business to be a leaner, more efficient version of what they are today. So I would expect that over the next 6 to 9 months, you're going to see a lot of restructuring and reorganizations in corporate America.
And Mitch, Rachelle led the intro there with the news today from Kroger and Albertsons. In the survey, said 52% of the CEOs are still pursuing M&A. Any idea just in terms of why, and I guess why they would be a little bit more optimistic than I think we would have initially thought at this point?
Yeah, well, the interesting thing, Seana, is that when we look at the difference between the U.S. results and the rest of the world results, the U.S. CEOs are more bold. They know that they need to transact, to transform. And, they're still very bold on what's going on. They're bold on growth. And they know that in order to, stay ahead of the competition, the fastest way to get there is through M&A.
And you said it's more about prudent deal making. What are some of the conversations that they're having when trying to determine what should be an acquisition versus, say, a joint venture?
Well, I think they're really concerned around not overpaying. The multiples last year were off the charts. And so what we're seeing is, particularly with corporates, that they're doing much more diligence and making sure they're doing the right deal now for the right price. We haven't seen a lot of private equity in the market over the last couple of months. We expect that they will come back as the cost of capital continues to increase. We would expect that the corporates would retreat a little bit because the deals become more expensive for them, but the private equities are still sitting on a lot of dry powder. They'll re-enter the market and take advantage of the lower valuations, and that's important for them because I think there was a lot of overpayment in the last year.
Mitch, one big trend that we've been following very closely, obviously, is this tight labor market. It's been a huge challenge for companies to lure in some of that top talent. Did this come up in your conversations with CEOs? And I guess, what are they doing in order to attract talent to their firms?
Yeah, input costs, was a big issue for our CEOs in terms of inflation. And so talent is one of the major input costs. The survey really did not touch a lot on the different things that they're doing to attract talent. But we do know that clearly it's been a significant impact. I mean, unemployment is at its lowest rate in 50 years now at 3%. So it is a tight labor market out there.
And Mitch, obviously, we're in a very different place than we were 2 years ago when the pandemic was first kicking in. In terms of how CEOs are now thinking of the pandemic and the pandemic-related issues that they're focusing on when they're trying to come up with their strategies, what were their priorities?
Well, it's interesting because, the pandemic is still the number one concern. I was listening to your earlier segment around the CDC's sort of concern around the rise in COVID. But when the CEOs are talking about the pandemic, they're really using it as a proxy for broader issues. So it's not just the health concerns that we had 2 years ago. It's it's inflation. It's the increased input costs, labor and such. It is supply chain issues. It's factory shutdowns in China. Those are all top of mind for our CEOs. So the pandemic was the number one concern for them. But following behind that, like 8 points behind that, though, so a distant second, was regulatory concerns, followed by geopolitical concerns, and then also climate change.
All right, certainly lots for them to contend with. A big thank you, Mitch, for joining us from EY. Thanks so much.
Thank you.